Good evening, friends. Welcome to this webinar for analysis of monetary policy review statement, which was announced on Friday by RBI Governor, Mr. Shaktikant Das. So this particular MPC statement was very crucial because all over the world, economies are fumbling now. There is a problem in almost every economy, and as RBI Governor said, India seems to be a kind of island in a sea of instability. But I think India will also not be able to remain isolated from the kind of turbulence which we are witnessing everywhere. And to tell you more about this, we have on our panel today Mr. Sundararajan sir, Dr. Farid Ahmed, Mr. S.C. Kalia. So first of all, Sundararajan sir will be explaining to us the economic background, domestic as well as international, which was the background or backdrop in which the decisions of the MPC have been taken. After that, Dr. Farid Ahmed will be explaining to us what are the decisions taken. And after that, Kalia sir will be explaining to us what is the sectoral impact of these decisions, how they are going to affect us, and with particular reference to banks, how banks are going to be affected by these decisions. So I'll not take much time. I'll invite, first of all, Sundararajan sir to start his presentation and tell us about the backdrop in which these decisions have been taken. Over to Sundararajan sir.
Yeah. Good evening, Mr. Arvind and my ablest mentors, and then the faculty members, and then special invitees and the participants. Mr. Arvind, I request that we are seeing this. Mr. Arvind was saying this monetary policy is a definitely challenging policy. With every day passes, it becomes really challenging for anyone, for that matter, RBI Governor or the party or the officials at the power. It becomes difficult. Now, let us commence with this. See, I'm going to take the inputs from his speech, and also outside, I took some pains to take the inputs from what is happening outside and then give you a thing so that you will be able to understand that, especially people who are working in the field, you need to have a complete idea. As they say, knowledge is power. You will be able to excel with the knowledge that you are going to possess. See, Governor, as he started talking about the global environment, he started saying that no, since the last MPC meeting in June, we are experiencing a successive shock to the global economy. He brings out the three important points. One is that no, inflationary surges that are taking place. It's not an inflationary position, surges that are taking place globally. And then each government, with a view to contain this inflation, they resort to what is called tightening the financial conditions. And then now, as it happens, one of the important currency, US dollar, has experienced a sharp appreciation. And as we experience this, the global bodies like IMF or the World Bank, they start saying that the global economy will not grow this much. They start cutting the growth rate of the different economies, including our economy. Why it has happened? If you analyze why it has happened, it is because of the main reason is the war in Europe, and also the monetary tightening policies resorted to by the different institutions, different government, different central banks across the globe. And also there is a risk of recession. People start saying that there is going to be the economy, the global economy is going to be affected by the recession. So as I already said, the multilateral institutions like IMF have started now revising the global growth rate, and then they brought it down by few notches. Now, what is that? When there is a pandemic and there is a war, and now added to that now China and Taiwan, what is going to happen? We do not know. Assuming that it happened, then it is also going to compound the problem further. All these things resulting in the fragmentation of the economies, and then reshoring of the supply chains, and then retrenchment of the capital flows. See, these are going to be the challenges for the global economy. Pandemic, war, existing war, and also the envisaged war, and then the fragmentation of the economies, and then the supply chains, and also the retrenchment of the capital flows are going to be the real challenges. And then what happens is, when there is some trouble, people resort to risk aversion, and then global market, especially the financial market, experiences the volatilities and large sell-off, that is moving of the capital of the funds. And then because of the demand for dollar, the dollar also soared to the highest level. And both, it is not that it is only the emerging market economies that are getting impacted. Advanced economies are also witnessing what is called the weakening of their currencies against the US dollars. And needless to say, emerging market economies are somewhat what you call nimble-footed. They are experiencing the capital outflows and also foreign exchange reserves coming down. And then this is resulting in exacerbating the risk to their growth and financial stability. I mean, to state it simply, globalization of the inflation is coinciding with the deglobalization of the trade. That is the best way of putting all the things. Now, as we go through the sleepless days, there are some inputs that are coming from the Food and Agriculture Organization. Friends, you may remember in one of my presentation, I was just saying that Food and Agriculture Organization has already cautioned the global economy, saying that there is going to be there, because of the inflation, there could be a possibility of certain sections of the people experiencing the famine, and there will be a social unrest. Now, same Food and Agriculture Organization, what it says is the global prices have started falling, and then United Nations Index of the World Food has plunged about 9%. This is the lowest since January, and consecutively for the fourth month it is falling down. Though the prices are elevated, but putting pressures on the low income world, because of the increased seasonal availability in Argentina, Brazil, where the maize harvest is progressing ahead, this will ease the pressure on prices. That way, Food and Agriculture Organization has given a word of comfort. As we go further, the emerging markets are facing the thing. Portfolio outflows are taking place consecutively. In the month of July, if we take the consecutively for the 5 months, there has been a movement. And because of the global recession risk and also the inflation, and then the strong dollar drew away all the cash. There is an Institute of International Finance which makes a study. Last Wednesday, they came out with a study. They brought out that out of the emerging market economies, about 9.8 billion dollars were moved out in July month itself. And then when we compare it, it was about 3.8 billion in June, and in the 35 against, and the 35.1 billion inflow in July 2021. Again, the background of 35.1 billion inflow, now we are experiencing 9.8 billion outflow in July, and then 3.8 billion in June, etc. Net outflow over the past 5 months from the emerging market economies works out to 39.3 billion, according to the Institute of International Finance. And then cash is left at the emerging market because the developed economies have started offering high rate of interest with a view to contain that inflation. They try to jack up, the rate increases rampant, so the money starts moving. And then again, needless to say, Russia's invasion of Ukraine in February triggered a spike in the food and energy prices that increased the challenge. Now, commodity, see, when you see these commodity exporters, especially in the emerging market, they gained revenue and then they heightened the payments to counter the strength. But that is only for a while. We are going to see in the subsequent slide, even in India, exporters have started meeting the commerce minister, started making certain demands. So most of the recent dynamics inflows can be attributed to the dollar. IIF again state this, that because of the increase in the interest rate in the US already done and envisage that it sooner or later US economy could also reach to a station of what is called neutral rate, a stage where there are possibilities of further rate may not be there. And once it reaches, it will stop the outflows of the money from the emerging market economies and there will be a stability. As we already seen, the dollar index 21-day moving average and last Tuesday, it closed at the highest level since 2002. Then from the, again, the economy, the IIF again cautions us that what is the thing? There are several factors will influence the flow dynamic, that is the movement of the funds outside. What is first important is have the inflation peak.
Sundararajan,
yeah.
Your slides are not being shown, sir.
Oh, not seen?
Not.
But I'm just putting it. The first thing, the global, what are the things, financial environment, how it is deteriorated, which the RBI Governor started with the thing. Then how the pandemic and war, and there is a greater fragmentation, and then the reshoring of the supply chain, that what we have does. And then the next is, again, if Food and Agriculture Organization, they gave us a comfort, that comfort element is put in this. And then next one, emerging markets, how there is a movement of funds that has been captured in this slide. Then next one, what we were discussing at that point of time, that IIF economists are also saying the flows can settle down only when US reaches what is called as a neutral rate. Then again, for the coming months also, what factors will influence the flows dynamic? Again, they are saying the timing of the peaking of the inflation, and then what is going to be the outlook for the Chinese economies. See, July saw, as we already seen, though there is an inflow of 2.5 billion equity market outside China, the first month of inflow since February, China emerging market debt posted 6 billion. Outside China, emerging market equity, there is a flow, but debt found that 6 billion has resulted in the outflows. If you are going to look at the China saw net outflow of $6.4 billion, comprising of 2.9 billion moving out of the debt portfolios and 3.5 billion moving out of the equity. China is not a insulated one. China is also getting affected. Again, it talks about among the Asian economies, how they are doing. What they are doing is, they are all engaged in this slide, what we captured is, they are all engaged in protecting the currency strength. They are making use of the foreign exchange reserves towards strengthening their currency. Especially India, Thailand, and Korea, they made use of reserve to the extent of 115 billion this year towards protecting their currency. See, they are not increasing the rates to contain the inflation as well as to contain the currency rate, because they believe that slow and shallow hiking is better than resorting to a steep increase in the rate. That way, how it is coming, the old foreign exchange reserves are coming to the rescue of Asian economies towards protecting their currency. And then, see, Asian market central banks will not resort to an act of jacking the rate by 100 basis point, 150 basis points. They will go by gradual measures and then competitive hikes, as they call it, the competitive hikes. And then again, it is being reiterated by the different economies of different banks and different countries. They say that the buildup of the foreign exchange reserves provides the scope for central bank to exploit this as a means of backstop their currencies and contain the imported inflation. Again, China, it talks about, this slide talks about the thing. China is not insulated. Even its reserves have started coming down by 179 billion this year. And then their holding is 3.7 trillion. So many Asian central banks have accumulated the foreign reserves, and then they made use of it towards protecting their currency that is being thing, because they feel maintaining the currency stability is much more important to shore up the economic confidence and lowering the threat to the exporters and borrowers, especially smaller and more open economies. So they believe that protecting your currency, that is much more important. Then almost no economy in the world, this slide brings out, no economy in the world is spared by the dollar's relentless rise. South Korea, it talks about the different things. South Korea, which began rising the rate. See, what we should do is, South Korea, they started jacking the rate in a more aggressive manner. Even 12 months earlier, they started doing it. But even that economy is not spared. About $25 billion US dollars, there is a drop in their exchange reserves. The one is their currency, one is down by 9%. Thailand has also experienced 28 billion of depletion, and they also saw that no, their currency dropped by 8%. Philippines, Indonesia, Malaysia have also experienced the drop in their reserve position. Now, we talked about the global, and then everybody is predicting recession. There is going to be a recession. This slide captures what is the probability. Good thing is, India, there is a zero possibility of recession. China 20%, Japan 25%, US 40%, UK 45%, Germany 45%, France 50%, Italy 65%. So bankers, we can have a sigh of relief. India may not experience recession, but globally, different economies are going to experience recession. If it happens, then it will have an impact on this economy. Then this is what is the thing. Asian economies have been very, very gradual in a calibrated manner. They have jacked up the rate, whereas in Latin America, Central and Eastern Europe have hiked the rate much faster, and this graph captures that. Then here we are seeing the dollar dominance, how the different things are affected. And here you will find that the first one is the Indonesian rupiah, the second one is the Chinese renminbi, the third one is the Indian rupee, the fourth one is the Malaysian ringgit, and then the fifth one is the new Taiwan dollar, and then the next is the Thailand baht, and then we have the Philippines peso, and then the North Korean won. So as we can see, among the different economies, India is impacted, yes, but it is not much impacted. Compared to India, many other Asian economies are very much impacted. Now, we come to the global economy to Indian economy. Governor, Mr. Arvind has also quoted this as a part of his inaugural speech. Shaktikant Dasa, the Honorable Governor of RBI, says, in an ocean of high turbulence and uncertainty, Indian economy is an island of macroeconomic and financial stability. Now, let us see how we justify this. The first and the foremost thing, according to the governor, as well as we are experiencing, now Indian economy has resorted to broadening. Thanks to the good southwest monsoon, reservoir levels are all full. Kharif sowing is also in progress, though there is a slight reduction in the area under sowing, but It is marginal. And then it also talks about that the rainfall was 6% above the long period average as on 4th August 2022, with 30 out of the 36 subdivisions receiving normal or above normal rainfall. The total area shown under the Kharif round was 2.2% lower, but the storage in major reservoirs are 119% of that of the corresponding period last year, as well as 139% of the average during the last 10 years. Then demand side. This is very, very important. The demand side, because all along inflation, India that is experiencing is not a demandful inflation. It is because of the internationally imported inflation. Internationally, the cost has gone up, so we were experiencing the inflation. Now, on the demand side, the production of the consumer durables, domestic air passenger traffic, sale of passenger vehicles suggests improvement in the urban demand. Rural demand, it is a mixed signal. While the two-wheeler sales have increased, tractor sales have contracted. High frequency indicators of the services sectors like the railway freight traffic, port freight traffic, e-way bills, toll collections, and then commercial vehicle sales have all remained robust in June as well as July. Urban demand is strengthening while rural demand is gradually catching up. Merchandise exports have recorded a good growth of 24.5% between April and June, with some moderation in July. Non-oil and non-gold imports are robust, which indicate that there is a strengthening of the domestic demand. Investment activity. This slide speaks about investment activity is also picking up. When we look into the PMI, the Purchasing Managers Index, manufacturing, this one that has also rose. It is more than 50%. And then utilization in the manufacturing sector is also now above its long run average. Bankers, here there is a message to the bankers. Now the manufacturing sector has to improve its capacity building. So there is a good scope there for them approaching the bank for the credit availment. In the past, credit availment was low. Now, since they have reached the peak, they have reached utilization, the manufacturer is above its long average. Their need for fresh investment is there. They will. Bank credit has already accelerated to 14% on July 15, 2002. Last year, it was 5.4%. And then the data of the Q1 performance of the different companies also indicate sales, demand, and profitability are very buoyant. Then surplus in the liquidity system, in the banking system, it was about 3.8 lakh crores during June, July. In the past, April, May, it was 6.7 lakh crore. RBI has resorted to the various measures like the variable reserve ratio, variable rate reverse repo, etc. That way, it has started sucking. In between, there was because of the outflow of funds for the taxes and other things, there was a shortage, but RBI came out with a repo auction, thereby it managed it. This is captured in this slide. And then, when we look ahead, what is the outlook? There is a good progress of the southwest.
Sir, again the slide. Sir, slides are not seen again.
Oh, I'm sorry.
Sir,
No,
they
it's
are
working,
visible.
sir. It's
no,
visible,
working.
visible. Yes, sir.
Perfect.
Visible.
It is visible.
What's it?
Visible.
Okay. So outlook again, outlook, southwest monsoon is good. Kharif sowing is also started. Definitely it will boost the rural consumption. Urban consumption has already started showing the signs of improvement. There is a demand from the contact intensive services also. There is a better performance of the corporate. Consumer optimism is also improving. So we can expect the urban demand as well as rural demand to pick up in the coming months. The capacity utilization in the manufacturing sector, governments intended the capex push, expansion in the banking credit will all go towards strengthening the investment activity. RBI has also conducted a survey among the manufacturing firms. The manufacturing firms expect sustained improvement in the production volume and new orders in the Q2 of 22-23. And this is likely to sustain as per that survey up to Q4 of the current financial year. But again, this is not a, though it gives a comfort, RBI, especially governor, cautions, saying that the domestic economy always face the headwind from the global forces, the geopolitical tension, already Russia, Ukraine, and the expected tension from the China and Taiwan and US, and then the rising global financial market volatility, tightening resorted to by the different central banks of the thing, and also threat of the global recession. These things we should always carry in our mind. Then IMF, as already we have seen, IMF has slashed the growth rate of India to 7.4%, different, which is a thing. But RBI has stated the growth rate at 7.2%. So definitely it is a thing. It is not that IMF has slashed only the Indian economy's growth rate. Ladies and gentlemen, you are aware the 2023-24 also India's growth rate has been kept by IMF at 6.1. But global growth rate also IMF has cut. Then it is previously it estimated 3.6% global growth rate. Now it has been brought down to 3.2%. Not only that, IMF has cautioned, we should also bear this in mind. What it says, 60% of the world's 75 poorest countries are at the risk of debt distress, or it could be the debt default. That threat is also there. We are already experiencing Sri Lanka. So IMF is cautioning 60% of the world's 75 poorest countries are at the risk of default, debt distress, which is again what it says. It is not only that it is with the poorest countries, it is spreading to middle income economies also. Okay. As we move further, CPA inflation is to 7% during May, June, from 7.8 in April. Again, RBI governor is very cautious. He says it is above the tolerance level. Food inflation has registered some sort of a moderation with the softening of the edible oil prices and the deepening of the deflation in pulses and eggs. Fuel inflation moved back to the double digit in June because LPG price and the kerosene price hiked. Because of that has happened. And then this slide captures what are the spillovers from the geopolitical risk. It is uncertainty. The visibility is very, very poor. Only good thing is recently the food and metal prices have come off the peak. International food prices have also eased in the recent weeks, but they remain elevated. Then volatile and supply concerns are always there. And then the appreciation of US dollar is also creating the what is called, it is causing imported inflation pressures. And then the kharif sowing augurs well. The shortfall in paddy sowing, however, needs to be watched. Again, the kharif season, the shortfall, if at all anything, you have to watch out because it may create a thing, even though you got a buffer norm, but again, it may create a risk. That is what RBI cautions. Then again, it talks about the core inflation, that is the CPI, excluding the food, it is also at elevated levels. And then it talks about the liquidity credit and then the bank credit growth, etc. It's a repetition. Again, RBI cautions incidence of unseasonal or excessive rainfall can impact the food prices, especially vegetable prices. And then again, the greater transmission of the input cost pressure to selling price across manufacturing and services sectors may also create a price pressures. So elevated cost of living condition could translate to higher wages and further price increase, especially pricing power of the firms strengthen. Again, it is cautioning us. It is cautioning us. RBI, this monetary policy is full of caution. Again, the inflation trajectory is at a decisive point. Again, it also takes into account, it will soften depending upon the global development and also the domestic development. That is what is captured in this. And then RBI is committed towards ensuring that the inflation is kept at the comfortable level of 4%. And then RBI Governor has placed a compliments to all my banker friends. RTS, congratulations. Indian financial system remain resilient. This will help the economy to come out of the shadows of the pandemic and the impact of the war in repo. So banking system is also well capitalized, profitable, deleveraged. The corporate augurs well for the sustaining the recovery. Again, RBI conducted a poll, what is called enterprise surveys. It expects the input cost pressure to soften in the H2, that is June, September. Cost pressures are expected to get increasingly transmitted. Already we have seen. And then taking into account these factors, the average crude price thing, and RBI has kept the inflation projected at 6.7%, which our Dr. Farid will cover. So on the outlook, rural consumption is going to benefit the demand for contact industry. So urban demand will also increase, and then there will be increase in the bank credit. There will be improvement in the capacity utilization, and firms that are polled in the RBI's industrial outlook survey expect sequential expansion in the production volumes and the new orders. Again, the elevated risk emanating from the geopolitical tension, upsurge in the global financial market volatility, tightening of the thing may create some sort of a weight on the outlook. So it may impact on the outlook. Then let us not, again, we already discussed. Then India has also run down its foreign exchange reserve by 62 billion this year. Then even with the affected 50 basis point hike recently on the Friday, then India, here we are comparing how we are increasing our rate, how the US Fed is increasing. We are short of 225 basis point of the increase by the Fed. Then rupee has dropped. Well, rupee has dropped, but its impact is less on the Indian rupee. So lower rates and renewed appeal for equities and the tech sectors in India should help to run the problem. Then these are some of the press articles. It talks about, despite Indian foreign exchange coming down, India is remain at the fourth largest globally. It has not impacted much, and India compares much better than emerging market economies. Indian rupee is also holding. Our underlying fundamentals are wrong. We are resilient, and then our recovery is gradual and strengthening. Current account deficit is modest. Inflation is stabilizing. The financial sector is well stabilized, etc. Our debt to GDP ratio is also declining. Foreign exchange reserves are adequate. The governor, RBI, is giving a comfort. So again, here, some of the things like, GST is also improving. The high frequency indicators, the fuel sales, power demand, railway freight, car sales are all indicating improving, showing that economy is strengthening. Then this is the thing, and already we have seen purchasing managers index has improved to 56.4 in July from 53.9. Global headwinds remain. That is again a caution. You will be impacted. Again, even though the global growth has weakened, India is much better. Data showed the core sector grew by 12.7% in June, though it is slowed down from 18.1% May. Maruti Suzuki reported a 8.3% decrease in the July sale. Power consumption was firm at 129 billion units, an increase. And then petrol and diesel prices sales rose 12% and 18% respectively in July. These are all giving the strength to say that Indian economy is improving. Growth movement is expected to be resilient despite headwinds from the thing. Monetary policy will pursue further in the stance of withdrawal accommodation to ensure inflation moves to this. RBI Governor goes on assuring. So this is what I was saying. Exporters and the Industry Association met the Commerce Minister, raised certain demands, saying that our orders are going to be cut from the thing. So yeah, there will be a moderation in the external demand. The export sectors feel by in the second half of the current financial year, exports will get further moderated. So rupee depreciation is also not that much. It is not providing it much comfort. That way they are saying that, so they wanted for some alternative solution from the Commerce Minister. Then according to the preliminary data, which you have seen, India's merchandise exports declined to a 5-month low of 35.2 billion in July. 7 of the top 10 export items comprising 80% of the total exports saw contraction. Engineering goods, petroleum products, gem, jewelry, pharmaceutical, ready-made garment, cotton yarn, plastic. Trade deficit is also widened to 31 billion US dollar in July. Exporters fear further slowdown in exports, especially from November. So, however, Commerce Secretary says India is worried, but we are looking for different regions. For especially, he is saying that no, Australia, United Arab Emirates, etc. Sri Lanka also we are saying we would like to boost our trade with Russia, etc. So even though there is headwind, we are confident that India will cushion itself on both trade deficit and current account deficit. That way is given. And then the Commerce Ministry, this we already seen. Indian economy is holding steady, progressing in an ocean of turbulence and uncertainty. This is the RBI Governor statement. As we celebrate the Azadi Ka Amrit Mahotsav, this is a moment of reckoning, reflection, and renewed resolve to work for the betterment of economy. RBI has reiterated its commitment to maintain price and financial stability to place our economy on a sustainable path. Our actions have helped the economy to tide over a series of shocks in the last 2.5 years. We are sized of our role in this critical juncture. Will persevere our efforts to ensure safety and safe landing. That way, this is to give comfort, friends. I have given you what is the state-wise debt to GSDP of the ratio. The best is Gujarat, 19.0. And then the maximum, I won't call it the worst. The maximum is Punjab, 53.3. It is within that range. Different state governments are there. That way they are doing. And then, should you worry about the fall of the Indian rupee? Indian rupee is 7.49%. Different currencies, how it has moved. Japanese yen about 20.66%. And then this is only for to reduce the tension I have brought out. Obviously, the credit card market in India, bankers, you will do this. I will be forwarding this slide to Mr. Arvind, who will share it with you. And then once, the bankers, I thought, WHO has come out with the stress management. They say, what are the physical signs of stress? I would appeal to all my banker friends to ensure that you are free from this. What are the various symptoms of stress? And you are free from it. And then the conclusion, the RBI Governor has also started quoting the Mahatma Gandhi, for me, the road to salvation lies through incessant toil in the service of my country and their proof of humanity. He has quoted. I'm sorry, I have taken a little bit more time, Mr. Dr. Farid, Mr. Kalia Saab. I'm sorry. Thanks for your patient hearing, and we will look out. Thank you so much. Thank you.
Thank you very much, Arvindji, and good evening to all my seniors. Thank you, sir. Sundararajan ji, you have started and given the almost all economic background internationally and domestically under the circumstances under which this monetary policy committee has met and announced its policy. First of all, I will start with the inflation, how the MPC has decided. As already told by Sundararajan ji, under the circumstances, how this inflation is projected in the coming quarters. Before going to that, let us see this graph, how the inflation, consumer inflation has moved, CPI from last 1 year, 12 months. If we see first 4 months of these 12 months, it was a downward moment from July 21 to October 21. From November 21, it started moving upwards and reached the peak in April to 7.79. though the consumer price inflation has eased from 7.79 to 7.04 in May and 7.01 in June, but remains uncomfortable because it is higher than the targeted inflation of 2 to 6%. This is the 6th strike month. That is, you see from the Jan, it started 6.01 up to June, it is 7.01. So for the 6th strike month, it is higher than the targeted. As discussed till now, because the inflationary pressures in India are very broad-based, and that's why it is remains at an elevated level, because the inflation trajectory heavily dependent on nowadays the evolving geopolitical developments, international commodity market dynamics, global financial market developments, and the volatility in the global financial market, which is impacting the domestic financial markets. And also even though there is a little ease in the inflation by 3 to 4 basis points from May to June, and about 80 or 78 basis points from the April, still it is a very elevated level of 7.01%. And keeping all these factors and presuming that the southwest monsoon will be normal during the 2022, and also keeping the average crude oil price of Indian basket at $105 per barrel, the MPC is projecting the inflation at the level of 6.7 for 2022-23, with quarter 2 at 7.1, quarter 3 6.4, and quarter 4 5.8. They have kept the figures as it is, as estimated or projected in the June policy MPC meeting. And they are projecting CPI inflation for quarter 1 of 23-24 at 5%. Though they are optimistic about these inflation rates, the RBI Governor has taken a precautionary, he has mentioned a precautionary note that this all depends upon the geopolitical situations globally, and also the monsoons impact, how it will be in the coming days. And incidentally, the wholesale price index was double digit for the past 15 months, and it was highest in the month of June at 15% level. So friends, not only CPI and WPI also, it is the highest in the last 12 to 15 months. Coming to the GDP growth, in the background of the GDP growth, again, Sundararajan ji has described very well, and he has given. So RBI has maintained its growth forecast for year 22-23 at 7.2%, as it believes that the recovery is gathering the momentum and strength. Expecting a good progress, as I told earlier, the southwest monsoon, and it also expected that the Kharif sowing will support the rural consumption. And urban consumption is expected to benefit from the demand for contact intensive services, and better performance of the corporates comparatively, and improving the consumer optimism, and increase in the capacity utilization about to 75%, and government's capex push, and large expansion in the bank credit. Large, why I'm using the word is 14% growth in the credit is definitely under the present circumstances, it is the large expansion. So all these things, and expected increase and sustainable increase in the production volumes for the quarter 2, which is likely to sustain through the quarter 4. The MPC kept the growth of GDP at 7.2%, even though the domestic economy is going to may face adverse impact from global forces, as discussed by Sundararajan ji, that geopolitical tensions, rising global financial market volatility, and global recession risks. Though the percentage of India getting into recession is 0%, but because of the recession expectation in other countries, its impact on their economies, definitely it will have an impact on Indian economy. So taking all these factors into consideration, also the RBI has maintained its annual and quarterly forecast at the level where they have forecasted earlier, that is Q1 at 16.2, Q2 6.2, Q3 at 4.1, and Q4 at 4%. And the GDP for Q1 to 13-14, they are estimating at 6.7. Then Indian foreign exchange reserves were at the level of 573.9 billions. As it was discussed already, the merchandised exports, its moment and all. In fact, they grew in April, July 22. The exports, merchandise exports grew in those period. Imports at the same time, they have gone very high, recorded a high level of the till now on the back end of the elevated global commodity prices. It is not the quantity wise, there is no increase in the imports, but because of the global elevated commodity prices, the imports surged to a record high, which resulted into a deficit of almost all 4 months deficit itself. It is about $100 billion between April to July 2022. So demand for service of the exports, especially IT services, and they are remained buoyant in the Q1 despite a global uncertainty. This is one positive point because the IT services exports were on the rising side and they are buoyant. And also the exports for travel and transport services also improved in the Q1. Though there was a outflow of the funds, portfolio funds, and also the Reserve Bank of India has used the reserves for maintaining the dollar price stability, still it is a net foreign direct investments are at 13.6 billions in the Q1 2022-23 compared to 1 year back, it was $11.6 US. So in fact, the very good news was, though there was 4 weeks, there was a continuous fall in the forex reserves. In the last week, there was a net increase of the forex reserves to an extent of about 2.4 billions, which made our reserves to be $573.9 billion. Then coming to the rupee depreciation, already our Sundararajan ji has discussed it, but one major this thing is our depreciation of the Indian rupee is not on the basis of the weakening of the macroeconomic fundamentals of our country, but mostly on account of appreciation of the US dollar rather than our weakness of our economy. During the current financial year, the US dollar appreciated by 8%. Even then, Indian rupee depreciated only by 4.7%, which is a good sign. Market interventions by the Reserve Bank of India have helped to containing the volatility and ensuring the orderly movement of the rupee, which because of this, there was a downfall or the reduction in the forex reserves because they have used the forex reserves accumulated over a period of time to curb the volatility in the exchange rate. Despite the resultant drawdown, India's foreign exchange position as per them is remain stable and it is the 4th largest globally. So friends, even though there is a last 1 month, there is a reduction, I also feel that the forex reserves position is comfortable as of now. Then policy rates. This is as expected. MPC decided unanimously to increase the policy rate by 50% basis points to 5.4%. Consequently, the standing deposit rate increased to 5.15 and marginal standing facility and bank rate has been increased to 5.65. As you are all aware, the first increase in the policy rate in its off-cycle monetary policy during the month of May by 40 basis points. And in fact, that was the first increase in the policy rate in nearly 2 years. And then the second increase in the policy rate, it is in the June policy by another 50 basis points, which increased to 4.9%. Now with this present 5.5% increase, this is the third time in the last 3 months the policy rates were increased. As far as the stance is concerned, the MPC also decided to continue the focus on withdrawal of accommodation to ensure that it remains within the target going forward while supporting the growth. This is they are continuing this policy. So then coming to the liquidity management, whatever they decided in the earlier policies, that is the gradual calibrated multi-year withdrawal excess liquidity in the system in a non-disruptive manner. The standing deposit facility, which was introduced in April 22 as an additional tool for absorbing the liquidity, has raised the floor of the liquidity adjustment facility corridor. Whatever that rates they have given there, it has reduced the LAF corridor, and it has been continuing the liquidity adjustment corridor at only 50 basis points. To alleviate the liquidity stress, the Reserve Bank of India conducted a variable repo rate auctions of 50,000 crores each of 3 days maturity on July 26th. Surplus liquidity in the banking system moderated to about 3.8 lakh crores during June-July 2022 from 6.7 lakh crores during April-May. The sharp moderation in supply of liquidity can be attributed mainly on account of the tax payments and also capital outflows. So, and this resulted in money market rates also to be firming up above the repo rate. So the Reserve Bank of India, while announcing the MP's policy, it has clearly told that whenever it is required, it will be vigilant and on the liquidity front, and it will, whenever required, the RBI will conduct a two-way fine-tuning operations as and when warranted. The two-way fine-tuning operations are, that is conducting a two-way fine-tuning operations, both variable rate repos and also variable rate reverse repos operations of different tenors depending upon the evolving liquidity and financial conditions. Coming to the regulatory measures, standalone primary dealers. Standalone primary dealers have played an important role in the development of the financial markets in India. Considering their potential in further facilitating financial market development, these following two measures were introduced, that standalone primary dealers to offer foreign exchange market making facilities subject to prudential guidelines. In fact, this provision is there for the authorized dealers till now, commercial banks, but they have given it now also to the standalone primary dealers. They also will be permitted to undertake the transactions in offshore rupee overnight indexed swap market with non-residents and other market makers. These two measures will help to provide the customers with a wider set of market makers to manage their foreign currency risk. This will also increase the breadth of the forex market in India, the first measure. The second measure will supplement a similar measure announced by the RBI in February for the banks. These measures are expected to remove the segmentation between offshore and onshore OS markets and improve the price discovery. Keeping these two things, they have given this facility to standalone primary dealers also. Second is a draft master direction on managing risks and code of conduct in outsourcing of financial services will be issued shortly for comments from stakeholders. So this announcement has been made. So you are all aware from time to time the Reserve Bank of India announcing certain guidelines on managing risk in outsourcing of various activities by the regulated entities, because in view of the increased use of the outsourcing, it is felt by the Reserve Bank of India and the committee that it is needed to strengthen the framework of regulated entities to manage the associated risk. So therefore, to harmonize and consolidate the extant guidelines, a draft master direction is expected to be issued shortly. Next, enabling the Bharat payment system, because you are all aware that the Bharat payment system is the interoperable platform for standardized bill payments. In fact, this has transformed the bill payment experience for users in India. There are about 20,000 plus billers as are the part of this system, and also more and more 8 crore people are using these transactions are processed on monthly basis. So it is now proposed to enable this Bharat bill payment system to accept the cross-border inward bill payments. This will enable non-resident Indians to undertake bill payments for utility, education, and other payments on behalf of their families in India. So in fact, this will benefit the families of the NRIs in general and senior citizens in particular. That is the expectation of the Reserve Bank of India. With that expectation, they are enabling the BBPS to NRIs also. The fourth one is the inclusion of credit information companies under Reserve Bank of India integrated ombudsman scheme, and also introduction of internal ombudsman scheme for CIs, that is credit information companies. If you are remember, the Reserve Bank of India has introduced in November 2021 integrated ombudsman scheme by integrating the three different schemes of internal ombudsman scheme of the RBI, that is for the banks and NBFCs and digital payments. So in fact, that integrated ombudsman scheme has improved the customer grievance redressal mechanism. In fact, because the customer can complain to the Reserve Bank of India to only one ombudsman instead of going to the different ombudsman. And the integrated ombudsman scheme has got experience of the individual NBFC, individual banks, and also the individual digital payments put together. Their efficiency has been improved. Keeping that, they have felt that this customer credit information companies have also to be brought under the scope of this integrated ombudsman scheme. So they have taken, they have introduced this ombudsman scheme for credit information companies under the integrated ombudsman scheme, besides introducing an internal ombudsman scheme for the credit information companies from this year onwards. In fact, the integrated scheme, which was introduced, as I said, more than 1.5 years back, it has helped in reduction of turnaround time of the grievance redressal under RBI IOS scheme, and also it has a very broad-based, as I said, with the experiences of the independent ombudsman scheme. This has given them to decide the grievances to sort out at the earliest, and it also provided a cost-free alternative redressal mechanism for it is going to provided against the banks, NBFCs, and the digital payments together. Now it is also going to provide cost-free alternative redress mechanism for grievances against credit information companies. Then it is now proposed to set up a committee to undertake a in-depth examination of the issues, including the need for transition to an alternative benchmark for MIBOR and suggest the way forward. In fact, the Reserve Bank of India has been taking various measures from time to time to develop the interest rate derivatives market in India. So such measures have led to diversification of the participant base and increased use of IRD instruments, particularly MIBOR outright indexed swap contracts. So keeping this view in the recent international efforts to develop the alternate benchmark rates, the Reserve Bank of India is proposing to set up a committee to undertake an in-depth examination of the issues, including the need for transition to an alternative framework for MIBOR and suggest the way forward. So friends, these are the various announcements made by the Reserve Bank of India. Before concluding, a few points I want to say what is our views. So as while presenting our June policy, we have said that there is a possibility of increase in the policy rates in the coming policy meetings. So the MPC decisions have been in line with our expectations. In fact, it is moderately hawkish. This hawkish policy has focused largely because on the elevated inflationary measures. And according to, though the Reserve Bank of India is projecting or estimating the inflation at 6.7 level, 7%, we presume that it may be a little bit 20 to 30 basis points. It may be definitely less than 7, but it will be definitely more than 6.7, because the Reserve Bank of India assumed the crude oil price at $105 per barrel, whereas in the current market level, it is almost all $120 per barrel. Though the Russian supply is the major in the basket, definitely the impact of this crude oil will have impact on the inflation. And furthermore, this is not as Sundararajan ji was said, demand push inflation. It is the imported inflation. We should not think that we are insulated from the global inflation. What the mistake we committed some 7-8 years back or 9 years back, that global financial adverse impact will not be there on India and our economy is insulated, and we have invested and encouraged the promoters to do, which has resulted in the bad asset quality. Like that, we should not think, and our economy is not insulated because our exports, our income from the exports depends upon the other economies. So we estimate that it is 6.9%. As far as the GDP is concerned, though it also again depends upon the other economies also, but it may likely to achieve 7.2% for 22-23. If not 7.2, it will be definitely more than 7.2 because of the capacity utilization in manufacturing sector has improved to 75.3%, and expecting a good progress of the southwest monsoon and kharif sowing, urban demand, rural demand, and better performance of the corporates, and expected credit growth, and particularly the government's ambitious capex push. These are all will give a push so that it is likely to achieve this target. If not 7.2, at least by 7.1, the target will be achieved. Then, as I said already, the hawkish policy. Then, given the increasing external imbalances and global uncertainties, again there is a need for front-load action. So again, in the coming next scheduled MPC meeting or the next one. So in the next 1 or 2 scheduled MPC meetings, definitely the policy rate will increase by 25 to 35 basis points, taking it to about not less than 5.75%, 5.75%. Then as of now, Forex reserves position is comfortable. As I said, export of goods and services together with the remittances are expected to keep the current account deficit within the sustainable limits, external debt to GDP from 21.2% to 19.9%. Net international investment position to GDP ratio has improved from minus 13.2 to minus 11.6. Debt service ratio has improved, and the external debt for the March was $615 billion, and short-term debt is only $273 billion. Keeping all these, the forex reserves position as of now is comfortable, though it has a fall from the $601 billion to $573. And then rupee is unlikely to fall significantly from current levels because it is already 79 plus. So we expect that it may be around 79 to 80.25. In between this range, it will move, because the Reserve Bank of India is actively playing the role, keeping the market, international market in view. The Reserve Bank of India is using the accumulated reserves and also increasing the rate of interest. After the increase of the 0.5% repo rate recently, I feel it is unlikely to move significantly, but definitely the moment of the rupee depends upon the US Federal Reserve's rate hike trajectory, because it all depends upon that. But anyhow, we feel that it is expected to remain between 79 to 80.25. Then normalization of the liquidity front in the banking system is quite visible, because it is moderated to 3.8 lakh crores in June, July 22 from 6.71 crores lakh crores during April, May. So keeping this, it is normalization is happening, and definitely it is an indication that the Reserve Bank of India is on a track for gradual withdrawal of the accommodation policy. So friends, this is what I want to share with you. Kalia ji, please.
Thank you. Let me first of all.
Sir,
Okay, Kalia sir, please start.
Okay. So good evening, friends. Let me first of all start by conveying my compliments both Sundararajan sir and Dr. Farid for very, very elaborate and exhaustive, I think, presentation that they have made to explain the global and domestic economic considerations against which the current monetary policy was announced, as also the specific measures that have been announced. I think Sundararajan Sahab has not only covered what was stated in the monetary policy, but much beyond that, in order to give us all deep insights into what is happening globally, particularly in addition to whatever is happening in domestic economy. So thank you, Sundararajan sir, and thanks, Dr. Farid, for your presentations. Well, friends, I have been asked to, share my thoughts with all of you on the impact, sectoral impact, and specifically on the impact on the banks in respect of the monetary policy announcement that have been made. In order for me to do that, it is important for me to state that the impact can be properly assessed only if we can recapitulate that monetary policy statement is not only the policy rates that are announced, it also includes the stance that is announced in the monetary policy, which is very important. It also includes the kind of liquidity management forecast that is given by the RBI as to how they are going to manage the liquidity conditions going forward. It also takes into consideration all the consideration that have been taken by the MPC in coming out with a fresh or retaining the GDP forecast and the inflation forecast. And beyond all this, in respect of the regulatory and development measures that are announced as a part B of the monetary policy. So we have to take into consideration all these aspects in order to assess its impact on the banks in India. Now, friends, first let's take the policy rate hike announcement of 50 basis points in the repo rate and correspondingly in all other rates that have been announced by Reserve Bank of India. Now, what is going to be the impact of the same? Now, it is very clear that you will all appreciate as more than half of banking system loans are linked to external benchmark rate. At least those banks, which are retail focused or MSME focused, they will be passing on these 50 basis points increase to their customers automatically. All right. And given the current environment, this would definitely enable them to improve their net interest margin because their rates are linked to, these loans rates are linked to the external benchmark rate. That is one particular impact that particularly those banks which are focused on RAM sector, they would expect, because these loans are floating rate loans links to external benchmark. All right. Second impact has to be in respect of, because of these policy rate hikes, there is going to be some kind of sectoral impact also. And while it will definitely impact all sectors of the economy, in the retail segment, I think housing loan segment is one which gets impacted because their EMIs definitely go up. So whether this, as rates will go higher, some segments can see some kind of impact on the demand for credit. Possibly yes, but I will explain in my view why it may not so happen. And there may not be that kind of contraction in demand, though you cannot rule out that possibility because of, in case interest rates go up, some kind of adverse impact on the demand takes place. And the banks, then in that particular scenario, ability to increase their particular portfolio gets impacted. So that is because rate increase definitely has some kind of impact on the credit growth of particular sectors which are too sensitive to the interest rate hikes. And I gave the example of housing loan sector. Now, in case we go little into other aspects, if we go into the background of GDP growth being retained, forecast being retained at 7.2%, despite IMF, as Sundararajan sir was explaining, coming out very recently with reduction in our GDP forecast from 8.2 to 7.4%. What is it that the RBI was getting guided by? Right. And I think Sundararajan sir has very elaborately explained it. What are the reasons? And I would only like to explain it in a context of its impact. Growth projection has been retained because they were talking about resilience of Indian economy, which is quite clear from the kind of PMI data that we have received. We have seen the high frequency indicator which were being talked about in detail. I will not get. Then Dr. Sundararajan sir also talked about strengthening of urban demand because of the data pointers that he was mentioning. There is a pickup in investment activity that is taking place. And above all, manufacturing sector, there is going to be a, there is a buoyancy in manufacturing sector because the capacity utilization of the sector has gone up very significantly to 75.3% as against long-term run average of 73%. So this all gives some confidence that despite global headwinds, I think we will be able, and despite IMF coming out with a contrarian projection about the growth forecast being reduced, Reserve Bank of India believes that because of the resilience of the economy and various data points, I think it can be hoped that we will be in a position to achieve this particular level of GDP growth. Now, it was also mentioned in the same context that our credit growth, on a YOY basis has been 14%, to which I think Dr. Farid Ahmed also mentioned. And our deposit growth, he didn't mention, that was only 5.4%. Now, what I am trying to say is that if the credit growth has moved, though it may have some bit of, base level impact also, this growth, but looking to the movement of credit vis-a-vis deposit growth, it is a clear indication that there is quite a great deal of pickup in the credit that is being experienced by the banks. Would this continue, this particular momentum? My view is that credit demand pickup would continue because of what has been stated, particularly in respect of the manufacturing sector, where they have said that there is a capacity utilization levels are at more than 75.3%. And another factor that they have talked about is about the capital goods production going up on a consecutive basis. So all this, and with the kind of, capex push that is being given by the government, and the kind of, pickup that is taking place, and all high frequency indicators about air passenger traffic and the demand for contact intensive sectors. If we take into account all these factors, it is quite apparent that there would be a pickup in the economic activity, and whenever there is a pickup in the economic activity, there is going to be a pickup in the credit demand. So impact is very clear to me that the credit growth is going to go up. If, unless and until there is some kind of, another geopolitical environment that plays out, and we are, in that kind of scenario which Sundararajan sir was talking. We are faced with pandemic now, Russia-Ukraine war, and third scenario that is being envisaged after visit of Pelosi to Taiwan is the kind of, tension that are brewing on China, between Taiwan and China. Now, these kind of geopolitical tensions can definitely happen. RBI has been cautioning about that. But assuming that there is not that kind of, severe global headwinds, credit growth would definitely pick up going forward. That is, that can be, understood from whatever has been stated by the governor in its policy statement. So this is, I think, very, very, very important from the point of view of the whatever has been stated in this particular policy statements. Now let's come to the inflation. Inflation forecast, if we go by the number that was shared by the Reserve Bank of India and which has been also shared by Dr. Farid, Q2, while they have retained it at 6.7%, they have made some adjustments in the quarter-wise projections. and Q2 they are saying it will be 7.1%, and Q2 it is saying that it will be at 6.4%. All right. And we have to also keep in mind that the inflation projections have been retained despite acknowledging so many factors which are having a softening impact on the inflation. As Dr. Feeth was pointing out, it was at almost 7.8%, and thereafter it is showing some kind of decline, and it has come to almost 7.1%, even lower than that. So that is the trajectory that we are, but we still are maintaining the same level of inflation projection, because it is still being believed that there are inflationary expectations very visible in the economy, and keeping in view that it is not likely to inflation is not likely to go down anytime sooner. So that is why for second quarter they are talking about 7.1%, and even for the third quarter they are talking about 6.4%. So while this stance that has been reiterated is, which I think he put it in one particular slide, which is very important to remember, that they will remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. So this is a stance that has been reiterated by the RBI in its monetary policy committee meeting. So if that is the kind of scenario, personally I am of the view, and I think all of us would agree, that there is going to be further rate hikes. All right. And people may prefer to go in for some kind of fixed rate loans from the system rather than going in for floating rate loans, if that is what they can negotiate. Whether the banks would agree to that or not is something, but possibility of further rate hikes happening, which is definitely going to be the scenario, which I personally believe at least there is going to be further rate hikes of, according to me, minimum 60 basis point, maybe 35 basis point once and 25 basis point further. There is a possibility of people going in for some kind of negotiated fixed rate loans, looking to the trajectory. But though I think it may be tempered by the fact that the projection that has been given by RBI for Q1 23-24 is 5%. So if that kind of decline is likely to take place, then probably people may still like to believe that once we have reached that terminal repo rate level, which I personally believe RBI may be having in mind of around 6%, then probably thereafter there will be stability in the rate, or with the softening of the inflation and easing of geopolitical tension, rates may start going down, and there may be possibility of some kind of rate reduction going forward. So that is something that is definitely going to play out with the prospective borrowers, this particular inflation forecast and its likely impact on the future rate cycle hike cycle that is going to play out. Now, in addition to this, we have to come to the specific regulatory measures that have been announced by Reserve Bank of India in its monetary policy statement. Now, before that, let me also talk about liquidity management. Now, you would have seen from the statement that it has, surplus liquidity in the banking system because of the pickup in the credit demand has come down from 6.7 lakh from April, May, 6.7 lakh crores from April, May to around 3.8 lakh crores in June, July. So it has come down, all right. But recently they have also gone in for one BRR of 50,000 crores because of the, and I think Dr. Freeze mentioned they are going to have a two-way approach. They may come out with a BRR, that is variable rate, variable BRR decision or VRR decision, depending upon how the liquidity conditions play out in the economy and the banking system. So in order to deal with the liquidity requirements. So in case that is the kind of scenario, then the issue would come up whether, at all point of time with this kind of credit growth that is taking place, whether this kind of liquidity support which the bankers are having currently, that would contribute to making available the funds for the credit growth, or the banks would have to increase its deposits rates also. According to me, and if you would have read RBI Governor's statement, he has nudged the banks for raising deposit rates and said that banks cannot repeatedly rely on central bank money to fund credit growth. That particular caution has already been given. Now, if you will see what kind of deposit rates hikes have taken place. So rate hikes have been very, very modest, and weighted average domestic term deposit rates, there have been only, in case we look at weighted average domestic term deposit rates, in May they went up by 4 basis points to 5.07, and in June they went by 6 basis points to 5.13%, despite the fact that there has been so much of a repo rate hike by then. Now it is clear that with the current repo rate hike and with the kind of stance that RBI has, banks will have to go in for a deposit rate hikes. This would bode well for the savers. And according to me, they will have no option, because deposit growth rate was only 5.4% YOY as per the latest data. It has to, in case credit growth picks up, because of this particular scenario, I think deposit rates are also going to go up. And then I will come to now specifically regulatory measures. About the standalone primary dealers, two measures that have been announced that I think Dr. Freeze has shared with you for standalone primary dealers. Definitely, this is going to broad base the foreign exchange market for certain, and there would be definitely much better opportunity for our institution to manage there, because if now standalone primary dealers are also being given permitted to be market makers in foreign exchange market, as was the case currently with the primary dealers which were being run by authorized dealer banks, dealer 180 category 1 banks. Now this would definitely broad base the foreign exchange market, and people would be in a position to hedge their foreign currency exchange risk in a much better manner. Secondly, I think this is also a very good move to permit SBDs, standalone primary dealers, to undertake transactions in offshore foreign currency settled. This we must remember. This is only offshore foreign currency settled OIS transactions with non-residents and other market makers. So this will, whatever little bit of divergence between onshore and offshore market, that would also, I mean, with this disappear, whatever little arbitrage was still available. And in respect of one particular announcement that has been announced about Bharat bill payment system, it will be definitely welcome move, because this would enable non-resident Indians settled abroad to have this particular facility for the purpose of cross-border bill payment system. And as Dr. Freeze was explaining, I think now they would be able to use this system for payment of utility bills, education, and other expenses for the families living in India. So that would be very good. That is a very good measure that would definitely help the non-resident Indians. About these the CICs, credit information companies, I think that announcement to bring it in the fold of integrated, ombudsman scheme of Reserve Bank of India, and also to ask them to have their own internal ombudsman. I think this is going to be very, very significant for the banks, because you must have also experienced many times there are customers who dispute their CIBIL scores on the grounds that this is not a correct information and this account was already settled, how I have been shown like this and that. So there has been always lot of complaints about the customer redressal grievance system so far as CICs were concerned. And this introduction of internal ombudsman scheme for them, as was prevalent for banks and NBFCs and digital payment system, I think this and bringing it under the integrated ombudsman scheme of RBI, I think this would definitely help the prospective borrowers for quicker redressal of their grievances, and it would definitely pay way for some kind of positive impact on more people being in a position to avail of the credit facilities. And I think there was one more announcement that was about this MIBOR. I think MIBOR benchmark, as Dr. Freeze was explaining, is being very, very effectively being used by all the market participants for interest rate derivatives in our country. But I think the way the MIBOR is fixed, there are some concern because it is based on some transaction which takes place within first few hours. So they just want to look at this and also to come out with some kind of recommendations as to whether, I mean, we can go in for some alternative benchmark rate as against the MIBOR, or there can be some kind of refinement that can be worked out as to how MIBOR is, actually worked out. So that would also enable, I think, market participants to have better benchmark rate for the purpose of interest rate derivatives, and it will help all the market participants significantly. So these were, I think, the major announcements and the kind of impact I believe it is going to have going forward in the banking system. But I think if we have to look into the kind of overall scenario is that some segments some sectors may face some kind of impact because of the interest rate hikes. But one thing that I just forgot to mention was the impact on the treasuries. I think when we started amongst ourselves, we were talking about the kind of results that have been announced by State Bank of India, where the treasury, I mean, the loss is almost 6,500 crores. That itself, that has impacted their overall net profit also. Now, with this interest rate hikes, that is one thing that banks may have adverse impact, because higher the interest rates go on the kind of portfolio that they are having, particularly in HFT and AFS, this kind of, mark-to-market losses are going to be there, and it is going to definitely impact their treasury income. That scenario will continue to play out, according to me, till such time the expectations of further interest rate hikes are there, and this will definitely impact the profitability of the banks. To what extent this impact can be offset by increase in NIM, by increase in the demand for credit, by way of better deployment of funds which were being earlier being parked with Reserve Bank of India, that is something that has to be seen going forward. But it is believed that, there is going to be impact on the treasury income. However, overall net profit of the bank may not get that much impacted, because there would be also increase in NIM, there would be also increase in non-interest income because of the pickup in the credit demand, and there is also going to be other benefits that are going to accrue to the banking system. But some impact would be there. That was one last point that I think I wanted to make. Thank you so much. I think if there are any questions that can be invited, and we can answer. Thank you.
Thank you, Kalia sir. And we had some beautiful presentations today explaining in detail the monetary policy statement. And now I invite questions from the audience. And Kalia sir, there is a question from Ansale sir. He could not ask that question. He has sent a message to me.
Yeah.
His question was, how does this high inflation, sorry, that was my question. I just say, whether rising interest rates will have impact on existing infra projects leading to cost overrun?
No, to the extent, to the extent they are linked to floating rate interest, to the extent all these loans are linked to, floating rate environment, there is going to be impact as and when there is a reset that takes place. So it depends upon the frequency, whether it is 1 year, rate setting, or 2 year or 3 years, it is definitely going to have impact. So whether it is infra sectors or
because infra comes under corporate, whether the benchmark rates are linked to the external rate or not, it depends upon that.
But if you will see how the benchmark, the rates are calculated by banks, it is definitely they will have to take into consideration the incremental portion. So that incremental impact is going to come in the fixation of the rate, and ultimately it will pass on to that extent in the ultimate rate that has to be charged.
Little time lag will be there, sir.
Yes.
Not
Sorry?
like RAM. Unlike RAM.
No, that is not. That is why I said.
corporate loans,
That is
time
why
lag
when
will
I
be
was
there.
talking about impact, I only talked about impact on, because there is a direct transmission in that,
Yes,
because it is linked to the external benchmark rate. But here it is not going to be
yes.
direct. Yeah.
Another question from Tangsale sir was, while oil is pushing prices as a policy, should the government be encouraging and offering concessions on electric vehicle and grant them priority sector status?
Sir,
So
please,
say it
can you
again, I
please
couldn't
repeat,
hear.
sir?
While oil prices are pushing up. So as a policy, electric vehicles be encouraged by offering concessions and priority sector status.
No, this is definitely, if we take into account the overall scenario, I think this is some suggestion that must receive the attention of the government, and whatever they can do in order to mitigate lesser consumption of oil, that should be a welcome move, because we are not the producer of the oil, we are the importer of oil. And to that extent, it would be always beneficial for us to encourage, whether it is CNG, whether it is electric vehicles.
Also
I think-
to achieve SDG goals, sir.
Yes, and sustainable development goals. Absolutely,
SD,
Dr.
sustainable
Sundararajan,
development goals also.
because if we have to become,
Yes,
so
yes.
these fossil fuels have to be, I mean, definitely discouraged.
So, a question from my side, sir.
Mhm.
Many economists, they have justified the use of foreign exchange by RBI for maintaining the stability of dollar. And they have said that an umbrella is meant to be used when it's raining. So when the rate was becoming unstable, RBI used this. No problem with that. But the kind of forex reserves we have, because we don't have trade surpluses,
Hmm.
they are more dependent on FDIs and inward remittances. Does it add some comfort, the kind of forex reserves we have?
The foreign reserves definitely provide a lot of comfort.
It is
Because
there. It's a nature of forex reserves, I'm saying.
the nature of foreign reserves is, see, we have to look into account the kind of, he has mentioned in his policy statement, what is our external debt to GDP ratio, right? What is that? It has come down. It is only 21%. So,
Yes.
I mean, our foreign exchange position is quite comfortable as against many of the countries which are facing, as Sundararajan sir was pointing out, that there is a possibility of default. That's not the kind of scenario that we can have in our country. And foreign exchange reserves are being used by RBI not for the purpose of maintaining a particular parity level. That is always their stated policies, that we do intervene the markets only to manage the volatility, not to achieve a particular level of parity between rupee and dollar. That's not done by RBI. That is only to manage the volatility. And if you would have read the statement very carefully, they said there has been an orderly depreciation of
Yes.
Indian rupee. Orderly depreciation.
Orderly depreciation.
Orderly. That is the
Yes.
word that it is not. And that is why, if there would not have been that kind of, prudent intervention, according to me, probably, I think, as that particular basket where the dollar has gone up by 8%, our currency has depreciated only by 4.7%. So these are all indicators that should give us a lot of comfort. And even after loss of foreign exchange reserves because of the intervention which RBI resorted, they are still at a very healthy level, as was very clear from the slide presented by Dr. Farid.
One more thing, sir.
Yes.
In fact, if they don't control the dollar against rupee, it will have a lot of wider implications and repercussions.
Yeah, absolutely. I mean, while depreciating rupee may be good for the exporters, but you also look into the kind of import that we have, and our imports always outweigh exports. But some kind of imports are good for the country, and you particularly import of capital goods is always a very welcome move for any country. All right, so long it enables us to go in for further investment, for further production, for further growth. So that is all desirable. According to us, on the external front, I personally believe that if I will call them doomsayer, who are talking that there is going to be a situation like Sri Lanka, which India is going to face.
That was not
That
there,
is not going to happen.
That is not going to happen. Yes.
We are very, very comfortable, according to me.
Yes.
Because all indicators are. I think Sundararajan sir Saab can definitely throw more light because he has studied.
In his presentation also.
No, Ms. Arvindji, I also brought out in my presentation. When we start now doing it, Indian rupee has maintained, and RBI has not indulged in over usage of the foreign exchange reserves towards containing the rupee. That is a very, very important part.
Very important.
If you take the Japanese yen, we always think that Japan is very strong, etc. Their fall was about 20.66%. And then if you are going to take into account the rupiah That is also 18.78. Pound sterling itself, 14.40. Euro, 13.42%. New Zealand, 11.72. And South Korea, 11.55. And then South African Rand, 8.42%. That way, Australian dollar, 8.04%. When we compare that, definitely RBI has come. Sir, but one problem is, sometime back, one of the revolutionary author has written an article. In that he has brought out, now India is getting a comfort saying that it has got a reserve, foreign exchange reserves equal to 11 months import, 12 months import, etc. But let us look into the composition. See, he started comparing China versus India. China's all foreign exchange reserves are built over the surplus arising out of the trade, and then it is insured. Whereas India, if you are going to take the composition, it's all the amount, either NRI funds following or IMF special drawing rights, etc., etc. That way, what is contention is, there is every possibility these monies may go out. It is not the global debt alone he is taking into account. Even the NRI money that is coming, it is I would call it as a most conservative argument of saying that no, everybody will withdraw the money and go. Why they should withdraw and go? Where is the alternative investment opportunity for you to do? So that is called as a too much of pessimistic view, and thereby saying that no, you don't have foreign reserve. The author went to the extent of saying you don't have foreign reserves.
Yes.
That way, that is to be dubbed as a negativity, total negativity. I think we should not pay heed to those things.
Sir, not Sundararajan ji.
Yes,
not only that, even if you take entire portfolio investment, stock investment in India, plus short-term debt, put together are lesser than our total forex reserves.
I agree.
Because long-term debt will not go overnight.
Correct.
Yes.
So that is, even though if you think that everything will go, portfolio will go, NRIs will not draw full amount overnight.
They will not.
So that is not the situation. Hypothetically also, we should not think like that.
FPIs have been withdrawing for a long time.
No doubt that China is established their forex reserves on the base of trade surplus. For us, it takes a lot of time, because as Sundararajan ji has said, some of the imports, suppose edible oil. Edible oil is one of the major, we are depending on the imports. Almost all, I think we are 3/4, 65 to 70% of the edible oil we are importing from others, out of which we are importing major part from Malaysia only. Sometimes that importing edible oil is better than the growing edible oil here, keeping other factors of the cultivation.
Yeah, there is a theory of comparative cost, sir. So
Yes.
they take into account what is the cost of producing. If what you are going to import is cheaper, why do you produce that way?
Yes.
It's an old.
No, I am not talking only direct, sir. I am not talking about direct economic aspects.
Yeah.
The groundwater aspect. See, China used to be one of the important exporters of rice once upon a time. Now they are not exporting, because they are thinking that it is wrong thing to deplete the groundwater fish.
Sure.
They may come to the market to purchase the rice in coming days.
Right.
Stopping the rice cultivation.
See, let me tell you, nature of foreign exchange reserves you are talking about. Yes, it is true that we have not built foreign exchange reserve through trade surpluses, as may be the case with some of the economies. But let's also examine, what is the kind of market that we have, and whether the foreign direct inflows will continue to pour in. I mean, we still don't have complete capital account convertibility, right? And still, in whatever sectors we are permitting FDIs, there is a huge inflow. And even now, there is no impact on foreign direct inflows. Impact has been, outflows have been more on foreign portfolio investments, where there has been outflow of 13.3 billion or something that has gone out. Otherwise, you just look at the stability of the foreign exchange and remittances. They are going to be always, perennial source of reserves with us. And some of the measures that were announced by Reserve Bank of India, recently when there was so much of volatility, they were all temporary measures, but they were very well thought out measures, where they have freed up FCNR deposit rates also. And now the banks can decide their own FCNR deposit rates. They have increased external commercial borrowings limit from 750 million to 1.5 billion. I mean, so many measures. So according to me, RBI is managing, I think, foreign exchange reserves and our external financial position very well. Let's not entertain any doubts on that.
Yes.
That's what I'm trying to say.
So another thing is that it was always being said that we are behind the curve. RBI is behind the curve. Now
nobody can say that.
Now we are at par.
No, we are not at par. As I think Sundararajan Sahab or Dr. Shri was mentioning, as against 225 basis points, we have done 140 basis points.
We have been calibrated.
But I am telling you, if we look at the overall scenario, there is, according to me, not that we are behind the curve. We have actually started front loading the interest rate hike.
Right.
The actual position is today we are in the cycle of front loading the interest rate hike. There is no question of anyone talking about we being behind the curve now.
Okay.
Because see, it cannot be just compared with one particular scenario. It has to be seen in the context of the domestic conditions that are prevalent in the country. What is the level of inflation rate in England? In UK, it is more than 9.some%. Look at what is happening in US. So we have to take into consideration. I think both Dr. Freed and Sundararajan Sahab, actually we are now front loading the interest rate hike rather than being behind the curve.
Mr. Arvind, I would like to add one thing to what Mr. Kalia Sahab was saying. You take that into account. I have provided one slide where I said some of the European economies as well as the Latin American countries have started hiking it much earlier. Even 1 year earlier itself, they started hiking it. What has happened to them? What has happened to them? When you see, by doing so, they thought that no, they are ahead of the curve. But unfortunately, they landed the economy into a deep problem. If you take into account, even for the example, Brazil, there also they are having a lot of problems. Inflation is high, interest rate is high, and the probabilities of their entering into recession is high. That way, it is all happening. It is always better. And RBI Governor has been saying not only these policies, even previous policies, we will not be guided by what is happening elsewhere. We will be guided by the indigenous conditions. What are the domestic environment that will go? That way, as Kalia Sahab has rightly said, we have to give the credit to the RBI.
Yes.
In a calibrated manner, they are moving towards ensuring that all is well within the Indian economy. I think many of these measures would have definitely insulated the Indian economy, and Indian economy is strong because of the joint efforts of the RBI as well as the parties in power. That way I would put it.
Right. So another thing, as Kalia sir and you were also saying, inflation rates are very high in other countries. So given that situation, will it be possible for RBI to maintain what has been projected as the inflation in projections that have been made for inflation?
See, there are so many global headwinds.
Yes.
I mean, I am telling you, he has talked about imported inflation.
Yes.
That is a very significant statement that he has made. And if we look dispassionately, how much is the impact? But inflation we are facing in domestic economy is an account of domestic factors, and how much is the impact of imported inflation. And if we believe that going forward, the geopolitical tensions will ease out, around supply side bottlenecks would come down, all right, supply side disruptions will not be there, then in that particular case, if that is the scenario that we are assuming, then surely I think this particular, I don't think we will beat this target. But as I think Dr. Freed mentioned in his presentation, he is expecting that instead of 6.7, it may go up to 6.9 or 7%,
Yes.
whatever he's talking. What I am trying to say is this will all be hereinafter data dependent. Let me be very clear, future rate hikes are going to be data driven, because one statement that he made, which we must take into account, is that future direction will be calibrated, measured, and nimble. That is what he has stated also. And if there is 3 words, what does that mean? Everything here and after is going to be guided by kind of data that is available with the right now. The action that was taken was not exactly on the data that was available, but it was bit of front loading in order to anchor the inflationary expectations in the economy, because generally it is believed that inflation is going to go up. That is very, very significant according to me. Hereinafter, all rate hikes will be more dependent on the kind of economic data indicators that they have with them.
So you want to say something?
Yes. I have a question for the learned panel. Now, this is with regard to concerns with regard to profitability of banks for the period like for 22-23, I would say March 23. I will give the background to this. Now, the geopolitical risk. Now, the RBI is watching the geopolitical risk. As everyone knows, Mr. Kalia sir also has pointed out. And China, due to this continuous COVID lockdowns, that's a key market supply. There's a supply chain disruption there.
Correct.
Compounded by the Russian war, and Putin is not, coming down on this war. He is intensifying the war. Now this is compounded by this Pelosi's visit, in which China is now flexing this military muscles, and the world is closely watching what China will do next. They have put certain sanctions on US already. Now, given all this background and the inflation, the Fed is watching the US inflation rates. The experts in the US have stated the inflation rates might not, stubbornly high, it might not come down in the short term, and Fed might increase the interest rates. That will have an impact on India also. And as the RBI Governor rightly put, this imported inflation, if this geopolitical risk rise, India will have to, even they have to increase the rates in the long term, like in the next policy meetings. Given that situation, my question is, already rates have gone up, and the transmission is happening to mainly the retail sector and the MSME sector. These are the mainly 2 sectors which are getting impacted.
Absolutely.
Yeah, and now again 50 basis RBI has increased the rates. Transmission will happen again. All the banks will meet again. Home loan rates might rise. Retail portfolio is facing a major problem there. And then going further, if RBI increases rates again, now what is happening is if interest rates rise in the retail, home loan rates are vulnerable.
Correct.
Compounded by I would put it here, RBI during COVID had given certain dispensation, like they had come out with RF1 and RF2 norms, that is regulatory framework restructuring norms, wherein due to COVID, retail and certain MSME clients were given 2 years moratorium in the loans. I think many banks have restructured that portfolio, and these loans now from 21, these loans will now get restarted in April, like from 23 onwards. That the 24 months moratorium will again be, the EMIs will again reset. At that time, this was not envisaged, the rates will also go up, this interest rates. So this will compound their EMIs, and if income levels are not rising of all the retail clients, it will definitely have some impact on the delinquency of the retail portfolio, home loan portfolio going forward. Because they will have a pressure, because if prices are not coming down, food prices are on the all-time high, even gas prices are at an all-time high. And if this don't come, they have a impact on individual incomes, which will have impact. And if the EMIs go up, and if they haven't restructured, it will have a compounded impact. Now, if there is a delinquency in the retail portfolio, like home loan, and to some extent MSME, and with banks not now having treasury incomes is almost dried up, MTM losses are there. Yes, yeah, rightly put it, Mr. Kalia sir put it, State Bank 6,000 crores loss. So they can't expect any income from treasury incomes. And if this delinquency happens going further, will it not have an impact on the profitability of banks in the next year? Say not in March, but say again in June 23 going forward. I'm assuming that geopolitical risks will rise in the near future, giving this tensions like China tension.
So let me try to answer your question. This is a very, very, I think, well thought out questions, particularly in the context of home loan borrowers and some other vulnerable sectors. I must say, Divakar, that you would have seen as to what kind of, regulatory measures were taken by Reserve Bank of India as and when any situation panned out.
Right.
Now let's go back to the pandemic days. What kind of measures were taken at that point of time in order to deal with the kind of shocks that the economy was facing at that point of time? You yourself have pointed out that they came out with both the resolution framework 1 and then 2 also. When they felt that yes, further relief needs to be given, they came out with a resolution framework 2.0 also, correct?
Yes.
In order to just relieve the stress. I personally believe, that is why I always say it will be all looking into consideration as to how this system is panning out. And I think given whatever experiences we have had till now, I personally believe if this kind of situation pans out and geopolitical situation worsens from here and things really move in different direction and this kind of stress is going to be experienced, I am of firm view that RBI will come out with some kind of regulatory measures in order to provide succor to the banks, because they do not want financial instability. Today, they have a pride in saying the banking system in the country is very well capitalized and profitable. They do not want to come out going forward with a statement that there is no, capital adequacy with the banks or profitability is going to suffer. So they will definitely, I think all of us as practical banker looking to the past conduct of RBI, experiences, we should believe that if there will be a situation like this, some kind of, regulatory release, maybe in order to maintain the EMI set level, same level, whether you can elongate the repayment period, some kind of measures would be definitely taken by RBI. That's my firm belief, basis my experiences with the policy announcements that have been made by RBI ever since the start of the pandemic.
So Divakar, I would like to add something to Mr. Kalia sir.
Yeah.
You are a positive man. Okay. So bankers have to be positive, saying that no, from regulator, whatever possible, in line with the international best practices, they will implement it now.
Correct.
Now, what about the bankers? Now they have to do their homework. Now the analytics are available. We need to categorize our customers also into A, B, C categories. Comfortable categories, moderate customers, and very, very, very nimble-footed, and then which will be impacted. There we need to focus and then do that. No, like what we do, sensitivity analysis, we'll have to take into account. Previously, we may not have attached a lot of importance to interest coverage ratio. Probably we learn lessons. We have to focus more on this interest rate coverage ratio. It is not sufficient if it is 1:1. We should think of some cushion for providing for external things that are going to happen. That way, it is going to be there. And then coming to the inflation, RBI Governor has also been saying this very, very again and again. He says now, these are all, much of this is the imported inflation. Some of them is due to the supply side constraints that are happening, inflation. Thank God it is not a demand pull inflation. It is a cost push inflation. Some of them imported, some of them are other costs. So industrialists themselves are optimistic. That is why RBI wants to do the ground check, saying that every now and then they come out with the surveys, from the survey also, they take their inputs and then they try to come out with the calibrate their policies and other things. I'm sure that no regulator will also address this issue. They are more concerned. We are looking from one micro. They look from the macro angle of that no entire system should not be impacted, what we need to do, etc. That way. And another area of concern, Mr. Kamath, if you are going to see how the bank credit has grown up this time, I read somewhere much of the hike is due to the increase in the personal loan. Much of that is not due to the manufacturing or anything at all. Personal loans have contributed to the much of the maximum is personal loans only. And we should always be cautious of the thing, the previous RBI Governor, Mr. Viswanathan, in fact, about 4 years back himself, you say, all is not well with retail. You should not derive a comfort saying that I'm moving from the corporate and the manufacturing sector to retail. I'll be more comfortable. So as a banker, we should keep on remembering. That is why I thought it fit to add the slide on the stress. how to remain stress-free. That we need to do. It's a more challenging, most challenging time.
Now, challenging times are,
Yeah.
geopolitical situation is the worst.
Sure. Yeah. Beyond our control. Beyond our control.
Pandemic, war, another looming large on our face. This Pelosi visit has created yet another tension point.
Yes, you are right. Your concern is right, Jenny.
Absolutely. Very well thought out. Very well thought out.
There is one question from Mr. TV Apparao. Would it not be better to regulate unproductive imports like gold than much intervention by RBI?
Would it not
regulate the import of
Would
gold?
It not be better to regulate unproductive imports like gold rather than interventions of RBI?
So whenever required, they take measures, they put duties on import of gold. That is a measure that is always available with the government, depending upon the situation of the imports and exports and the kind of deficit the country is facing. They will definitely, they may not stop, but they can always put certain duties on the import of gold, which can be prohibitive in nature. So, no country will say, no, we will not allow the gold to be imported into the country. Then entire gem jewelry sector will go out of the business. So there cannot be a blanket ban. But yes, should it be restricted? Yeah, it can be, definitely. And this, duties are always imposed in order to achieve that objective.
Sir, gold import, mainly it is being done for the exports also.
That is going why I was referring about gem and jewelry. It is because of that only that they import.
So it's not
because they have to
unproductive.
export. Otherwise, this entire sector, which is contributing so much to the export sector, will go out of business.
Yes,
so that is why blanket ban is not required.
Another observation, yes, sir.
Yeah,
Sir.
Dr. Farisa, your observation is right. In economics, we take into two concepts what is called productive consumption, ostentatious consumption. Ostentatious consumption is for speculation, I think. So, as rightly said by Kalia Saab, on ostentatious consumption, they will impose the duty so that it becomes costly for you, so that you will stop using it. On the productive, they need to do that, as rightly said, except in the month of July. Otherwise, the gem and jewelry have contributed a lot to the exports.
Yes.
Exactly.
Another, he has made an observation, and I'll invite comments from you. Our NRIs inflows may also decelerate to some extent as US rates will rise higher than our bank's offerings.
How it will impact our remittances? I
NRI remittances might reduce because rates in USA are going to be interest rate increase in USA is going to be much higher than what we are going to offer here.
How do we presume that we will not offer? Right now, RBI has come out with a policy statement where they have permitted the banks to offer whatever rates they want on the FCNRB deposits, though it is a temporary measure as of now. So I think it is a little presumptuous on our part to believe. What I am trying to re-emphasize is we are assuming certain scenarios
Yes.
and believing that RBI will sit back and do nothing. I think that is not a correct way of thinking. I mean, the moment there was too much of volatility and 80 rupees it crossed, they came out with 6 measures on that day. Though they were all temporary up to 31st December, up to 4th November, up to 31st October. But those measures were taken. So let's assume that in case that kind of scenario plays out, earlier they were not permitted, banks cannot quote anything. Now they have been permitted to, quote whatever rates they want on the FCNR deposits.
Sir, even if it is any impact is there, that may not be significant. Second thing is, even if you see that policy rate increase by the Reserve Bank of India, we are ahead of the Fed rate increase. We are anticipating that Fed may go increase by 75 basis points or 100 basis points and all. Before Fed rate is increased, we are increasing the rates. So
Correct.
as you said, RBI will not keep quiet.
No, they will not. They will not. And they have been very proactive and they have been monitoring all developments. I mean, this has given me a lot of confidence. You would have seen from my comments and observations. I am a very, very, very strong, I think, supporter of timely measures taken by Reserve Bank of India to deal with all kind of, issues that our economy was facing from time to time. And that has given me a lot of confidence that with the present dispensation at Reserve Bank of India, we can definitely believe as and when any particular situation pans out, they will be definitely coming with some slew of measures to deal with that.
Thank you, sir. So I don't see any more questions.
But one thing, Arvind ji, I want to add
Yes, sir.
Kamatji's question on asset quality on account of the rate of interest increase and pandemic special
Yes,
dispensation.
yes.
Irrespective of the rate of interest increase or policy rates increase, definitely the special dispensation given on twice, that to 24 months, is going to cause a lot of challenge for the banks because the income levels have not increased. The repaying capacity has not been maintained prior to the pandemic level, either MSMEs and all. But as far as the housing loans are concerned, you keep aside the existing loans, new loans demand will not come down because in the last 4 years, the housing loans have reached a rate of interest on housing loans reached a bottom. They enjoyed the low rate of interest, whoever the customers they availed. New customers may not get that opportunity, but it is not too high to not to avail the loans. Keeping the demand, even somebody is telling that this policy rate will affect the real estates to some extent, to some period only, its impact. But in the long run, this 1% increase, 0.5% increase in the policy rate will not have much impact on the real estate also. In the sense, housing loan purchases and housing loans. But special dispensation itself, definitely it will cause challenges. Why MSMEs? We have seen the special dispensations given a lot of challenge. Ultimately, we failed. That's why NPS have gone to 10 lakhs crores. After a series of special dispensations, starting from CDR to S25, 525, SDF 4, all those things.
Okay, so there is no more question, I think, and we can come to the end of this meeting. Already we have overshot by about, I would say, 50 minutes. 50 minutes.
Oh,
So it was a very wonderful analysis of the policy and very good discussion that we had. I'm very sure all the people who attended this webinar today must have been much enlightened by the kind of discussions we had, and it will be very beneficial to all of the attendees today. With that word, I come to the end of this meeting. We end this meeting now. Thank you. Namaskar. And I have to first of all thank Sundararajan sir,
Oh, thank you.
Kalia sir,
Thank you.
Farid sir, for the painstaking efforts they have made, because it was a very short period. Only day before yesterday, the policy was announced, and within 2 days to come out with such beautiful presentations on the policy and to explain it so elaborately. Hats off to you, sir. And Kalia sir, as always, he has such a deep understanding of the things that you tell the thing and immediately he tells you the impact.
He is a ready
Wonderful,
reckoner.
sir. Thank you, sir.
He is a
Thank
ready
you,
reckoner.
Yes.
No preparation is required.
Thank you, sir. Thank you.
He
Thanks
has
for your
papers on
blessing.
his tips. Immediately he can tell you.
Yeah.
Yes.
Thank you, sir.
Wonderful.
Thank you.
Thank you. Thank you,
Thank you,
everyone.
sir. We come
Thank
to
you.
the
Thanks to all the
next meeting.